Two, three. Good day, everybody. This is Jim Kinney speaking to you for OptionProfessor.com for the weekly market update. The date, of course, is August 2nd, 2019. As always, I remind you that past performance is not necessarily indicative of future results, and short-term trading and option trading does involve risk, so you should consult your clearing firm, your broker, your advisor, your good common sense, and consider all that, make a decision after you do all that on whether any of this type of activity is appropriate for you. Okay, we've had a lot of stuff go on this week since I brought you updated last week. First off, we had obviously the Fed meeting, and they did drop a quarter of a point, and then they've suspended running off the balance sheet 1 month early, I guess. They were going to do it in September. Now they're doing it in August. Of course, that didn't make Mr. Trump very happy, so what he did the next day is put a tariff of 10% on $300 billion of Chinese goods, obviously trying to get some more activity there, possibly driving the markets down, and possibly putting a little pressure on Mr. Powell to keep cutting. Mr. Powell's obviously looking at the data, and he's seeing that the data is not that bad. Matter of fact, the consumer is out there spending pretty darn good, and also the wages are going up pretty darn strong. And the things that are holding it back is industrial numbers and manufacturing numbers, which should surprise no one, because who's going to make a lot of money in business investment and business manufacturing when you are in a trade war with some of the countries that obviously are very big on manufacturing. So it doesn't surprise me. Plus you throw in Boeing and their problems with the MAX plane. Obviously they've got their own situation going as well. The industrials and manufacturing is definitely not going great, but that is, in my view, transitory, because obviously at some point the MAX thing will be resolved, so Boeing will be back and running. And also at some point possibly we'll have some kind of a deal. And whether it's a good deal, bad deal, or just a word called deal, it'll be a lifting a cloud, and I think manufacturing and business spending could pick up. So, and consumer, 2/3 of the economy, 70% of the economy, out there spending, employed, and making money. So we know that they like to spend because most people, obviously have very low reserves because they do spend. And we can see that the credit markets are out there loaning money to Tom, Dick, and Harry. So as far as the consumer's concerned, it looks pretty good. And so we are getting a pullback in stocks. The reason for that is I think much of the market was looking for a much more dovish tone out of Mr. Powell, who basically said, I'm going to go 25 points as a insurance cut, and I'm going to see how the data comes out like any rational man would, and not just cut like crazy man because Japan and Europe is doing it, because obviously they're not the world reserve currency. Our dollar is up quite a bit, and those other countries can do a lot more shenanigans because they don't have a reserve currency for the world like the dollar is. So at any rate, and their circumstances are different. Their GDP numbers are different. Their employment numbers are different. The whole 9 yards is different. And cutting rates down to 0 or less, Germany has bonds, 10-year bonds, I think, that are not only do you not get any interest or income on it, they actually take money away. They're called negative yielding bonds. And something that I find concerning is back in November, December, it looked like there's about 5.7 trillion of these negative yielding bonds, meaning if you went to get your money back, they would give you less than what you gave them. Now, that number is at 4 now. That seems to be accelerating at a pretty alarming rate. That's probably why the gold continued to be fairly firm here above 1,400, because it looks like it's a printing city out there around the world. And again, if people want to get that money out of there to use it for something, they're not even going to get their principal back. So those bonds, 14 trillion, are always going to be at risk to be redeemed and used for something with a positive return. That's the risk. The other thing is high yield, which I'll put up the high yield graph on it. Those numbers are going through the roof, and the risky loans called leveraged loans and private equity, they are also approaching $1 trillion. And I think triple Bs, which is the lowest grade of investment grade, that also is has a huge number. So what do you have in the debt market? You got 14 trillion in negative yielding bonds. What else do you have? You have the junk bond market and the triple B market exploding. So there's a trillion in that. And then you've got these leverage loans, short-term leverage loans, as well as private equity coming into a trillion. So, the world is awash in debt. And at some point, that could be a problem. Obviously, who knows when, but it doesn't take much to light the fuse if somebody defaults on something. And as far as these low interest rates in Europe, I mean, go look at the banks in Europe. They're totally under pressure. And look at their GDP and growth, and there's nothing to be found. So lowering rates and then people don't want to borrow anyway is not really going to be helping. Infrastructure and spending like that creates jobs and incomes, which feeds that 70% of consumer spending, that obviously would be more effective. Junk bonds, as you can see here, when we had the drop in December, it gave you an idea of what happens to junk bonds, right? That's a pretty good size 10% drop. This is fixed income. Losing 10 or 20% in fixed income is a big deal. Now it comes all the way back up and makes a new high here, and now it's rolled over a bit. So if we take out this 84, 85 level and this volume, which is still just growing a little bit, notice it's growing during the drops, and when it and another one drop. So when it drops, the volume has been very big. And when it goes up, the volume has been less. That might not be a great sign. All right, things that I've been telling you about. Let's start and give you a quick review. Put up the S&P graph, and I'll tell you exactly what I've been saying if you're new to the broadcast. Again, a background on myself. I'm Jim Kenny. I've been in the business here for decades. I've done hundreds and hundreds of seminars on the uses and risks of options nationwide. And again, I've been doing them on the internet now as well. All right, let me give you the S&P. The S&P bottomed out here when we had a big drop in December. Remember that, 2350? At that point, I was saying that we might go back towards the 50-day moving, 200-day moving average, which was 2750. We went up there pretty fast, right? Within about a month, back up there. Then it meandered between 27 and 2800. When it broke 2800, I thought the next logical place would be the high of 2950, which is what it did. Then it had a correction. Then it came back up and started testing it and made a new high. But I don't have the RSI numbers. If this area here has a lower RSI than here, then that's called a divergence, and that would indicate that this could have further weakness. Now, what I've been saying up here is I believe the 2950 to 3100 zone is a selling zone. It's a zone where you take money off the table. It's a zone where you would sell calls. It's a zone where you would sell calls and buy puts, called a collar. It's a zone where you might sell out stock and replace it with a limited risk option. It's a zone where you might just buy married puts, take some of the profit you've got and throw a couple of insurance puts out there between 2950 and 3100. Right now, that looks like a very good scenario that's working out. And I told you recently, if it got under this number here, which is about 2950, and the VIX jumped above 1517, that the market could have a further drop. Well, it's coming down and finding some support at 2900, which is not too surprising. Today's low is 2914. If we break under here, that sets up the 5 or 10% correction, which is 2800 or 2700. Okay, so here at 2900 is a very big area for it to hold, and the longer it stays under 2950, again, that's not so great. So that has been my scenario, and it remains my scenario. So again, 2950 to 3100, I still believe is a zone where you better be protecting yourself and taking some chips off the table. If you did that, and now we come down to 2900, 2800, 2700, if that's the situation, you might want a dollar cost average if you think this is just a correction. I'll show you a couple of things that lead me to believe that it may not just be a correction. First of all, the whole planet is long stock, right? So if everybody's all in, obviously, if they want to start coming out, there's not a whole lot of buyers. That's how you get order imbalances. That's how you get the S&P to drop from 3027 down to 2914 in 2 days or 3 days or whatever, because people want to come out and the buy line is very small. So obviously, you have no order imbalance. When the order imbalance is resolved, the market could pop back up. But if you got a wave of selling and no buyers, the guy who's performing the market is going to drop his bid as far as he can. Right now, again, here's some of the troubling stuff that I'm looking at here. This is the transportation average, which peaked out at 11,623 way back here
at what? September, October. Lower high than there, lower high than here, and now it's on the defensive again. It's underneath its 50 and 200-day moving averages, or at least it's definitely under the 50. It might not have broken under the 200. But I am telling you this is not something that is acting as if it's going to 12,000. So my feeling is, if you want to get really, really bullish, you'd want to see this transport break above 11,000 at least. At least. Okay, so keep that in mind. Right now, you're holding on to something that is, on the transports that is declining in value. This does not look like a massive uptrend right now. It looks like a market that's melting. Let's look at another one that's been a pretty good leader for my liking, and that's the Russell. The Russell 2000 is small caps, interest rate sensitive, and mostly in the U.S. Now, let's take a look at that. Peaked out way up here, 1750. Same thing the transports did. So the transports and the Russell are not agreeing with the S&P and the Dow. And these, obviously, if we were really going, small caps generally jump in at some point. And as far as transportation is concerned, if moving goods and services are not taking off, that's not a great sign. So here you've got what? Lower, way lower. I mean, we're 150 points off the high here, and it just tried to get above 1,600. If we can get above 1,600, then I'll start changing my tune. But right now, I think this is something that is more worrisome than it is supportive. Okay, so be careful of that. All right, going around the horn here to some of the other things going on in the world. What about the interest rate picture? They just cut interest rates 1/4 point. Again, Mr. Trump and the administration, they want us to turn into Japan and Europe, get these rates down to zero, do quantitative easing, and do all kinds of wild stuff. Now, again, we're at the all-time high area of stocks. We're at the all-time low area of employment. So if you use up all your bullets, and then the guy who's trying to force you to do it doesn't get reelected, and you're left with a mess, not unlike Atlantic City, where the debt market exploded on him down there, and he couldn't make the payments, and he defaulted on debt and things like that. If we run up some kind of a huge deficit, which we're doing, and they just suspended the debt ceiling until July of 2021. So these guys are going to be spending a ton of money. Now, that can obviously help the stock market go up, but at some point, obviously, it can get a little bit over the top, and again, if inflation does pick up and your interest rates are down at 0 or 1% or whatever, you're going to find a very unstable situation in the financial world, because you can't have the inflation rate jumping way above. And again, some people are thinking that these tariffs ultimately are going to be inflationary, because the people on the wholesale level may get tired of eating the tariff, and they may say, forget it, just put it on top of the price, and then the consumer is going to have to eat quite a bit more. So there's a lot going on there. Now, the interest rate market, look at this. We've got a 325 top on the 10-year note. That's 3.25% interest, right? Now, it starts dropping because we had the big drop in the stock market in December. So rates start dropping. And now people are thinking there's going to be 3-4 cuts this year from the Fed. So now they really start buying into the bond market. And as you buy bonds, that drives the prices up and the yields down. Now, right now, we hit a low of 1.833 yesterday. And right now, if we don't take out 1.833, I think it could be a situation where they could try to make this thing go back up a little bit. Again, going back towards 240, 250 could be in the cards. And I think, again, a lot of people down here were betting that way, that we're going to come back and up and at least go up towards this neighborhood and then maybe go back down. But again, the Treasury is going to be bringing a lot of bonds to the market. So supply is not going to be a problem. If demand, for whatever reason, takes a vacation, this is going to be a disrupting situation. Now, again, you're getting very close to zero again. 1.8 is only 1.8 away from zero. So the bottom line is we dropped over 125 basis points, 135 basis points on the yield, but the Fed has only given you 1/4 of a point. So again, this has dropped way more than what the Fed has done. And that might be telling you that this is an overdone situation, unless the Fed is going to start cutting like crazy, and there's really no evidence of that right now. Again, unemployment is very low. People are making money. People are spending money. And that's not generally the environment where you slash interest rates to zero unless you're doing something pretty irresponsible, in my view. Okay, because there will be a rainy day. And when the rainy day comes, you don't want to have used all your ammunition when it was sunny. In other words, just like anything else, if you spend all your money when things are good, when things get tight, you're in a bind. So bottom line, I think Powell knows that, and the people who work at the Fed know that, and they are not running for office, so they may have a different set of ideas. Now, again, the administration may force them into doing things because if they sabotage the stock market and then the economy does buckle, then, of course, obviously, that's a different set of circumstances. And that's basically, I think, what Powell's saying. People are bad-mouthing the guy, but, he said, listen, I'll give you a quarter of a point, as an insurance cut, or shall we say a mid-cycle adjustment, and then we're going to see what happens. But we're not just going to start cutting rates to zero because Germany and Europe is having trouble, or Japan has a systemic way of just printing money, buying their own securities, printing money, buy their own stocks. I mean, that's not the system that we're supposed to be having here. So I think Powell and his buddies are trying to be adults about it and go one step at a time, which is probably to be commended. Okay, let's see what else is happening in the world here. The price of gold has broken into a bull market. Let's see if it's still if it's having a pullback, because again, I was thinking it might have a pullback, but it's not going to have a pullback when you are starting to make tariffs go, and when you are and when you're looking at a situation where the consumer is spending money like he is. So the bottom line here is that you're at 1457, up 25 today. So people are taking insurance out by buying into the gold market, and that started in earnest when we broke above 1350, which I brought to your attention before. So right now, there is some real estate between the 200-day average and where we are now, so it's still possible to get a pullback unless we're going to just have a parabolic move up, which is possible. So if you're into gold investments, you would obviously hold on to them, but you might not add here if you're concerned about some kind of a pullback. And I'm going to show you where my technicals are, where it tells you that it might happen. See, your 200-day moving average here is at 1265, and you are up at 1457. So that is getting to be almost a couple of 100 points above, 180 points above, which is 20% above. Now, when you get 20% above the market or more on any market, you have to give some respect to the concept that you're getting pretty far away from its mean. And so, therefore, the possibility of a drop could be happening. Now, right now it's not happening, and right now I think it's making 52-week highs. Let me double check. I think it is. So holding on to what you've got makes a lot of sense. Adding right now could be a little dicey because of the fact that it's so far above the 200-day moving average. Now, drops, if you can get one, you see into this gap here. Well, hold on. Let me get back here. Yeah, let me get the right chart up. This is Barrick Gold, which is obviously doing good again today. And then put the continuous up real fast. And then let's see what we can do. Okay, well, I'm getting that done. Let me again tell you, though, that it's very, very strong in the gold market today. It's something that's not surprising to me because I've been bringing it to your attention for a long time. GDX is doing very well, but it all has a situation where it's a bit overbought. And so basically, what you want to be careful of is not to get in there. And then on a bull market, it's sell rallies, buy dips. Sell rallies, buy dips. Bear market, you sell rallies, okay, I just want to get the chart up here. Yeah, you can see it's making an all-time 52-week high, 1461, okay? But again, the moving average is way down here at 1250, and even the 50-day average is up in here. So again, some type of a pullback, if we don't really go straight to 1500, could be very in the cards. Right now, again, if you're holding things like I've been telling you, holding on to them is not a bad idea, and it looks obviously like it should be part of your portfolio. All right, let's look at the dollar, because that's what Mr. Trump is very upset about. We have a strong dollar. and he would like to see that dollar go in the toilet so that we could compete with the other currencies that are in the toilet. Sounds to me like it's a very flawed idea, because the people we want to compete against are not doing very well. And so to emulate people that are not doing well seems pretty silly. In other words, Europe's doing badly, so why would we want to go to low interest rates and a bad currency? Japan, is steady at best, and again, they're printing money and just doing all kinds of wild stuff with their money. So China has been shrinking a little bit. They're doing their own activities as well. But as far as the dollar's concerned, probably got a little bit overbought up here at 99, right? And again, I've been telling you this, 95 is the low area. 98.5 has been the high area. We peaked through it for a little bit. Now it's back down. So we're at the top of the trading range, And again, to make a big dollar call to the downside is very premature until you start seeing, obviously, some support getting taken out. Right now it'd be 96.50 and then 96. That would start telling you that the market's turning over. And if it does get under 94.95, going down towards 85 is not out of the question. So, if you see that happening, you'll probably also see the gold price up at 1,700, which some people are predicting. Silver is another one that people have been taking a look at here, and it has been playing a little bit of game of catch-up. Let me show you that as well. And the silver's at 16.28, and it's up today. But the gold to silver ratio, which hit way into the 90s, was shrinking quite nicely. But I think that has been suspended so far. But can you see why it came down to 16 here? Because those highs now are going to be support. So this would be an area where silver might be able to hold and get back going. If not, certainly 15.50 would be another spot. So if you're a silver player, 16, 15.50 would be good places for it to hold. And I'll give you the 200-day moving average real quick so you can see that. 1468, very overbought, right? Very overbought from the 200-day moving average. That's what I'm saying. If this thing's going to go parabolic because we have an event going on, then obviously, it's not going to have a pullback. However, if it is just a normal bull market that's going to take time to develop into a really big bull market, then backing and filling makes more sense. So right now, the metals really are telling us that either A, they're overbought, or B, they're going to go into a parabolic move because there's events coming that are going to cause disruption. With the Trump administration and the world the way it is, that's obviously probably a 50-50 bet. But historically, probability-wise, being this far above its 200-day average, is something that it could mean that you could have a correction. I just want to show you an example of sometimes when that doesn't happen. Okay. In other words, I think it happens quite often, but doesn't always happen. And I'll show you one time where it hadn't happened. This is called Chipotle, and Chipotle has been going through the roof. I don't know what they're doing there. I was there the other day. Just seemed like normal food to me, but they're willing to pay almost 100-to-1 PE ratio for these guys. Yes, they have some digital bags along the wall where people, I guess, call up, or online, order. Then they come in and just pick it up. They don't want to talk to anybody. I just wonder how long it is before they pick up the food and how cold the food gets while it's sitting on that shelf. But at any rate, that's a big part of their new sales is digital. Anyway, here's my point. My point is let's take a look at the 200-day moving average here. And Chipotle, 200-day average is only at 600, and it's trading at 800. So it's almost $200 above the 200-day average. Again, I think this thing should have had a correction, and all it gave me, since I had that opinion, because this 200-day average used to be at 500. And so it only had this one dip. I'll go back to the chart here so you can see it. It had this one dip of about $50-$75, right? Well, it went from a little under 750 down to 650, so about $100. That's all I got out of saying when it was up here and the moving average was way down here that it might have a drop. So it did give me a drop, but not a big drop, but it was enough drop to make some money on right here. But the point is that, again, we're still in the same area. This is the 200-day average, 600. We're up here at 800. So should it pull back? I would think so. But again, no assurances on anything, particularly on this kind of thing. that's an example of when the going back to the 200-day average doesn't always work. All right, what I'd like to do is go around the horn real quick. I got about 5 minutes, and I'm going to go around the horn and show you some of the different sectors, and let's see how they're being affected. I'm using the Vanguard mutual funds ETF. I'm sorry, ETF. This one's going to start out with energy. So energy, again, oil out of the blue dropped very, very sharply, and so has this stuff. So this stuff is on the very big defensive now. If you like to buy things that are out of favor, this thing is certainly out of favor. If oil can get above 60 bucks, this thing can get on the bicycle again. If it's dropping under 50, and this thing could go back down and make even more lows. But this is a neighborhood you monitor, because if it holds this neighborhood here, and if it takes out 85, okay, that probably would be coinciding with getting above 60. And if that's the case, then this stuff could be back on the bicycle. And stocks like Royal Dutch Shell, British Petroleum, and Chevron that pay great dividends would be worth a look. All right, let's switch over to healthcare. And these guys continue to make a lot of money. But some of the drug companies seem to be having some trouble. Now, this is healthcare here, and where are you here? Got very much overdone at 160, came back up to 175, and now it's just hanging here. Holding this 170 area is very important. But healthcare, again, on a longer-term basis, unless they totally revamp the system, is still always a worthwhile sector to keep an eye on. Turning towards some of the drug stocks, let's see, Pfizer. Everyone was touting Pfizer because, again, it has the good dividend, but it has been dropping from the 40s, 40, almost 45, and look at it down here. So the drug companies definitely have rolled over, and Merck, I'm sure, is not too dissimilar and stuff like that. Okay, what else do I got here for you? REITs. They always were hiding out in REITs, trying to get that yield and figuring real estate can save them from the big bad wolf. So let's see what REITs are doing. REITs are up because this is, again, where people like to go to get yield. You see the yield, 396. And again, it's backed by real estate, so people feel a little bit safer there. Let's look at utilities. That's another hiding spot. Let's see if they're hiding out in utilities again. They took a pause. You see the utilities took a pause, so did REITs, but now the risk off is on, and that's where people go because they like to get yield, and they believe they're a little insulated with those. Materials. People are thinking that material costs might go up. They started buying into it. Let's see if there's anything going on there. Not really. Looks like it's rolling over. Again, the stock market, in my view, people are all have these big upside targets, 3,200, 3,600, 4,100. It could happen. It could happen. But I wouldn't bet that way right now. With regards to what else do we have for you? Tech. Yeah, is tech getting nailed? Obviously, Facebook and Google and Amazon, they got the government looking at them. That's probably not a good thing. And you can see the tech's now on the defensive after making a new high. This would be a good one to look at RSI. What was the RSI when that hit? And what's the RSI here? And if it's lagging on the big move up, that's not a good sign. And that might be saying that this is a false run. Okay, let's see what else we got here. The banks. Everybody loves the banks. But again, if interest rates are going to keep dropping, go look at the European banks, and that can give you an idea how low interest works out for the banks. Not so good. So they gave it up on the banks as well. They're down here in the 27 area. Again, if rates go very, very low, it's not going to be a good situation for the banks, I don't think, because the profit margins go out the window. All right, and industrials, another one that's having a little bit of trouble. And Boeing, obviously, a big part of it, and you can see that's rolled over as well. Let's look a little bit at international here. Oh, yeah, one more, consumer discretionary. The consumer's supposedly out there buying a lot of stuff, but some of these people seem to be taking money off the table. Consumer is down pretty hard here, and you can see it's rolled over as well. So has this market made a false new high and is now going to go into a corrective mode, or is this just a little dip on a big bull market? Only time will tell. Those are the two scenarios most likely. EEM, when the dollar's very strong, I don't think you want to be in these emerging markets, and apparently I'm not the only one who thinks that way, because you've gone from 45, 44, now you're down to 40. So strong dollar is not good for EM. And then last but not least, we're going to look at Alibaba, which I think is the leader in the Chinese market. And BABA is also rolled over to the big downside pretty good too. So one up to 180, way down. So everything's on the defensive right now. Keep your powder dry and keep your eyes open. And again, don't get too bullish. Things are deteriorating here, and when we're late cycle, deteriorating situations. There's not a lot of people talking like this, and when most people are talking one way, maybe we don't have that many geniuses in the world. So again, learn how to hedge with collars and covered calls and puts. Learn how to hedge by replacing stock with long-term calls. My name's Jim Kenny, and you can reach me at Option, OPTION, Professor, PROFESSOR @gmail.com. Tell your friends and everyone else how you could learn more about this, and I'll be back with you next Friday. Until then, have a great day and a great weekend, and again, good luck out there. Thanks.